Can you believe it? I've been accused of being a snob, an investor snob. I only care about people that have lots of money, that have millions of dollars, that can build a portfolio with $1 million and invest it. And what about the young investor? What about the new investor? What about the person just starting out, or the young person who just got his first job? You know, what do you do for them? Well, hey everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. That was my fragile ego speaking. I was not really accused of being an investor snob, but I have had several young people ask me, you know, what can I do? You know, you're always talking about having large sums of money to invest. You know, how does the young investor get started? What do you do for that? I think it's a really excellent question. So in this video, I'm going to give you what I consider to be the indisputable, absolute best investment advice for young or new investors or people with smaller amounts of money that exists on the planet. I consider this advice to be indisputably the best possible advice you can get. And it was advice that I've rendered several times to young people myself and had the good fortune to have it rendered to me when I was young. And the advice is really simple. You know, all of us have bills to pay, you know, and of course, some are more sacred than others. Like, for example, no one would think of not paying their Netflix bill or their cable TV bill, or our water bill, for example, or our electric bill. Our water bill, if you have one, our electric bill, you know, you don't want the lights to go out, and you certainly don't want to lose your internet connection or your TV. Your mortgage, of course, is sacred. Your car payment, you need that to pay. So you have these bills, and most of us are, you know, dutiful citizens, and we pay those bills routinely. But here's the point. Here's the best possible advice that you could get, especially as a young investor. There's one bill that's more important, that takes a priority over every other bill that you could possibly pay. And what you have to do is you have to discipline yourself to pay that bill first and foremost. Before you pay your mortgage, before you pay your phone bill, before, you know, your cell phone bill, before you pay your electric bill, no matter what other bill it is, pay this bill first, and that is yourself. Pay yourself, and that's really the key to long-term investment success. Every month, every time you get a paycheck, especially if you're working, take a portion of that paycheck, whatever you can afford, and still pay the rest of your bills and maybe have a little bit left over. Pay yourself first, and then take that money and invest it. And the results are remarkable. And I truly do believe that's the best possible advice that I could give young investors. But there are some tricks to that. There are some principles that you have to apply, because regardless, the principles of sound value investing, being prudent with your selections, you know, following what I consider to be the time-tested, you know, principles of prudent investing are still apply and are still critical, but you're just going to do it with a different level of cash. So let's go ahead and get into the video here, and let me show you some things that I think really make this so important. I want to start out just by talking about the general status or state of the stock market, if you will. This is a fast graph looking at the S&P 500 going back approximately about 20 years here. And here's what I want you to note. The recession of 2001 was very short-lived. That's this gray shaded area. The Great Recession of 2008 into 2009 was very short-lived. The COVID recession that we recently went through was very short-lived. The market does from time to time fall, but in the long run, I want you to note that stock prices rise generally. Okay, so the key is, if you pay yourself first, like I talked about, and invest money religiously every month, you really take advantage of a couple of things. You take advantage of this upward momentum of the stock market, number one. And number two is you also take advantage of the principle called dollar cost averaging. And what that simply means is, if let's say you're investing $1,000 a month, hypothetically right now, okay, when the market would be very, very high, and say you were just investing it in an index fund, which would be one of your choices, but I'm going to show you some other alternatives here in a moment. When the market was very, very highly valued, you would buy fewer shares than when the market was undervalued or trading real cheap. And let's go ahead and use another example. Let's look at a company like Global Payments. Now, I'm going to kind of kill two birds with one stone. I had a good subscriber, Moma, lament that when I did the subscriber request series yesterday, I did not include GPN, which was one that they asked for. So I apologize, and here's a look at GPN. Now, the point is, I want you to note that this company, this is the kind of stock that you want to look for, okay? You want to look for companies that are increasing their earnings year after year after year. Let me take the price off of this graph and the blue line. I want you to notice this orange line is a plotting of the profits, and I'm using a PE ratio of 17.34 here because that equals to the growth rate. So the message is young people, I believe, should be oriented towards investing in companies with high growth rates, okay? And I define that as stocks that are growing and as consistently as possible at 15% a year or better. And of course, Global Payments certainly follows that trend. So this is the kind of company that you want to invest in as a young investor. Now, as far as dollar cost averaging goes, when the price is high, if you're putting in, these are weekly closing prices, but if you were investing once a month into this stock, if your investment happened to happen in, at the end of February when the value was real high, you would buy less shares than if you were investing when the value was very low. So what happens is your money automatically gets defensive when stocks or the stock you're buying is expensive, and automatically gets aggressive when stocks are cheap. But you're also taking advantage of the upward movement in stocks, whether it's the S&P 500 or an individual stock like Global Payment System I'm showing you here, and this is a 15% grower. Now, I think one aspect is you should focus probably more on fast-growing stocks than you will on slower-growing stocks. So let's test that a little bit and see what I mean by that. I've gone into the investor.gov site here, which is the Securities and Exchange Commission, and I'm utilizing and take advantage of their compound interest calculator. All of you could go to this. It's actually quite a fun thing to play with. So I'm going to do some what-if scenarios here. Okay, what if you're a starting out investor and you only have $1,000 to invest? Okay, so you invest that your initial investment's $1,000. But say you have a pretty good job and, after, paying yourself first, when you follow that discipline of paying yourself first, you're able to invest $1,000 every month. And let's just plot that for 20 years. Let's just do it for a reasonable time frame here, because I'm going to use that time frame here in a moment. Let's say we're going to do this every year religiously, every month religiously for 20 years. Now, our target rate of return is 15%. Now, that's a very aggressive rate of return, and I'll address that here a little bit more in a moment. But I also am going to use a variance here of 5%. In other words, so I'm going to be plotting 10%, and I'm going to be plotting 20%, okay? Now, I'm going to compound this annually just for simplicity here. And let's go ahead and calculate what investing $1,000 initially and then $1,000 a month every month for 20 years with a target rate of return of 15%. All right, so if I calculate that, what happens is, what I learn is that in 20 years, that simple process of investing $1,000 a month would give me $1,245,000. Now, if I only earned 10%, a lower number than that, and I'm going to address that here in a moment, then my rate of return would be $694,000. And if I was fortunate enough to earn a higher rate of return, like 20%, then my total net amount of money would be $2,278,000. Now, let me do one more thing here. Let me just extend this for a moment. Let's do this for 30 years, or I'm going to actually go 35 years. I'm going to call that the average working life. Watch what happens. Watch how magical that is. In 35 years, you'd have 10,707,000. If you did this over your lifetime and hit retirement age, I think just about anybody, regardless of inflation, could live on $10,707,000 a year. The interest alone, if you put it in bonds or CDs, would be enough to support most people's lifestyles. And if you put it in a high-quality dividend growth stock portfolio, you could actually have that increasing every year. Now, let's talk about the realisticness of some of these numbers here, okay? A 15% rate of return is kind of aggressive. I'm going to go back to the 20-year time frame here using this calculator, and I'm going to change this now to 10%. Okay, rather than to 15. I'm going to be a little more conservative. Now I'm going to calculate that. At 10%, I get, as I mentioned earlier, in 20 years, I get 694,000. If I only earned 5%, I'd have 399,000. But if I was able to earn 15%, then, my number would be 1,245,000, like I talked about before. Now, how realistic are these numbers? So I went into Investopedia here, and I simply asked, the question, what is the average annual return for the S&P 500? And I found some interesting data here, and you'll all be interested, I hope, to know this, that first of all, the index originally started in 1926, and it had only 90 stocks. Okay, and the average return from inception through 2018 was 10 to 11%. So that 10 to 11% number that I utilized in the calculator here is at least realistic because it's the average rate of return that stocks have generated. Now, interestingly enough, if you look at some in this a little deeper, the average annual return since adopting 500 stocks, which was in 1957, is roughly 8%. Okay, so 8 to 10% are what I would call a decent amount of numbers and then a decent return expectation. And then 7% is the number adjusted for inflation. Okay, so this is essentially what the market could give you. Now, there's another interesting table in here that I would be remiss in not showing you. This is the market returns from 1970 on a year-by-year basis all the way up through 2019. And I want you all to see this variance, okay? This is why dollar cost averaging works so well. There's nothing better than coming into 2008 and being able to, invest $1,000 a month in a collapsing market. Also, when you get these market years like you had, for example, let's say in 1996, where the market was up 38% that year, your money gets defensive. You don't buy a lot of the expensive stock, and you tend to buy more or get more aggressive with your money with dollar cost averaging when the markets are inexpensive, and you get more defensive when they're really expensive. Now, let's carry this a little bit further. Let's go ahead and look at the plausibility of getting a 15% rate of return, because as I want to repeat what I said earlier was young investors ought to be investing in growth stocks, in my opinion, because you have the time to go ahead and ride out that variability that I just showed you here, where you're going to have these good years and these bad years. As long as you're disciplined, discipline is the key here. The discipline to keep investing that money year after year after year. So I went to the Fast Graph screening tool here that's available to premium subscribers. And I want you to first note there's 26,777 total entries in this universe that I'm screening. So I simply went and I just said I want to hit all sectors on the whole GICS, General Industry Classification System sectors, and all sub-industry sectors. So I'm going to keep this very simple. Okay, then I went into the historic tab here, and I went to the annualized performance, and I clicked 20-year performance, and I simply said I want to see all stocks that gave me a 15% or better historical annual rate of return. Okay, and then I simply ran the screen. And what I got out of 26,000 plus stocks is I got 410 companies that had 20% or better earnings growth. So I got my historical performance, rates of return to the owner. So I went here and I sorted this by highest to lowest. Okay, so my lowest was 15%, which is what I queried. And you've got some companies in here. You can see some of these names you might recognize, some of them you wouldn't. But then I also screened it for the highest rates of return, and notice that you have some really crazy. So let's look at Monster Beverage. I'm going to go to the new version of Fast Graphs here, where I showed you global payment systems. By the way, this company is one of the ones that would have generated a 16.6% annualized rate of return over the last 20 years. Let's look at Monster Beverage. Forgot the symbol, MNST. Okay, there you go. Let's look at Monster Beverage. Again, what I want you to see is I don't have any dividends here. This is a non-dividend paying stock, but this is a classic growth stock. All right, now I'm going to put the price on here. There were plenty of times to buy this stock at a PE ratio equal to its growth rate, which is the formula I prefer for growth stocks. There was also times when the stock got expensive where your $1,000 a month would have bought fewer shares than when it was inexpensive or when it was undervalued, okay? But again, Monster Beverage, and these numbers I'm just running rough calculations here, would have given you a 34%, 33.8% annualized rate of return in its own. Now, what you can do is pick one stock a month, and maybe just buy a few shares because, this stock, for example, trades at almost $100 a share. So you could be buying about 10 shares currently. but you'd be buying defensively. When the stock was down here trading at 50, you could have been buying 20 shares. Okay, when it was inexpensive, and you'd be buying fewer shares, but you're just doing it month after month. You're being disciplined with your money. Okay, so these are the kinds of companies that you want to invest in. All right, that's critical. Now, I also want to make another point here, and very, very strongly, and I'm going to also go in here and look at a couple of companies that I was also asked to look at in my last video and show you the kinds of companies I don't think young people should be looking for. And I showed you how to find these companies with these historical, rates of return. This is a gold miner, Kinross Gold Corp, symbol KGC. This is one I was asked for yesterday. This is not the kind of company you want to invest in, because dollar cost averaging doesn't work here, especially if I go from peak to trough. If I go from these high valuations in here, I won't hit. Well, I did hit the very peak. And I, go down here for 15 or 20 years here, I'm losing 79% of my money. I'm averaging myself to oblivion here. Every time I'm buying the stock cheaper, but the problem is the stock keeps getting cheaper. This is not the kind of company you want to invest in. Now, you can even be more conservative. You don't want to go for all the monster beverages and the growth stocks, but you could also apply this to a company like Johnson & Johnson. All right, now your performance here is not going to be up to that 15%. Here you're looking at more like an 8% number. All right, but again, it's got consistent growth, and what you really want to do is you want to be investing in it when the valuations are cheap. Now, if you're too busy or you don't simply feel like you have the knowledge or the experience or expertise to be able to identify this kind of stuff, you can use your common sense and invest in the stocks that have been, great long-term performers. If you're a young investor, you can be looking at names like Facebook. Okay, which everybody, every young investor is aware of Facebook. And see, Facebook has only been around for about 13 years, but the performance has been over 25% a year. All right, so, it's a classic example. And again, you got times when your money would be defensive. Remember, the key is pay yourself first. The very, very best investment advice is be disciplined, and always, with every paycheck, have that bill. Look at yourself as an obligation. I'm obligated to pay myself my first, before I pay any other bill, and then I can pay my other bills. And of course, you just, depending on your budget and how much money you're earning, at working and so on, that might be $100 a month. It might be $500 a month. It might be $1,000 a month. But you can go to this Gov site here and you can play with these numbers. Now, I ran some, scenarios for you. Again, if you go to that 15% number, which I've shown you when I ran this screen and, calculate it here, in 15% a year, you end up with that 1,245,000. That's investing $1,000 a month. But keep in mind, as you progress throughout your career, maybe you can ratchet that up to $2,000 a month, maybe someday even $3,000 a month, or maybe only $1,500 a month. But the key is not so much the amount of money. The key is to be disciplined in doing it month after month after month and picking the correct stocks, because I do want to point out that I found 410 stocks that generated rates of return for 20 years averaging over 15%. Okay, the lowest, return I got for that was the 15% number. And that was a name that was, I'll use Credit Corp here as the example. And it was one of the lowest, returns of the 15%. But it did generate that rate of return. And that even did it with some trouble, because they went through, it's a diversified bank, and they, got hit in COVID. But regardless of that, they still ended up with that 15+% annualized rate of return over the long run. So the point is, pay yourself first. Go to the calculator here, use it, and run some numbers. If your number is only $500 a month, that's fine. It might only be $500 a month, and maybe it's $500 a month, for 10 years. Okay, because that's all you can afford to invest. You still end up with a very, very nice nest egg. And if you earned, 20%, you still get a pretty stout number. And if you only earn 10%, which is the historical average of stocks, you get a different number. The point is not whether these numbers are what you're actually going to earn or not. The point is, of the whole video, is to have the discipline to only, Never pay any other bill prior to paying yourself. Pay yourself first. That's really the key to this whole thing here. And, that's the message I want to leave you with. So I hope you enjoyed this video. If you did enjoy the video, then please, subscribe to the channel. Give me a like, pound that like button. Give me the thumbs up because I really appreciate it. Investing principles universally apply. Now, there are different strategies that you could use. Today, I talked about just being disciplined and investing a little bit of money, every time you get a paycheck, carving a little piece of that out and paying yourself first. That's the best way to achieve long-term financial success. And then apply sound investing principles to that and, and be disciplined. If you have a plan, the critical part of that is follow the plan. If you're afraid of the market's crashing, that's when you've got to have the courage to invest that $1,000 a month. And when the market's getting expensive, that's when you might want to back off a little. Remember the words of Warren Buffett: be greedy when others are fearful, and fearful when others are greedy. When the market's collapsing, that's the time to be greedy. When the market's too expensive, that's the time to be fearful. But you can overcome all of that by simply being disciplined. Thanks for watching.